All right, so stocks took a breather today. The question is how big the breather was, how significant it was. Obviously, you can tell where it wasn't very much of a big range today, which makes it a very interesting day in terms of this last 2 week rally that typically they end with small ranges. So we're going to take a look at that. I'm going to show you how that works, especially in conjunction with some of these other indicators. And then we're going to see, okay, like what would a exhale look like right now? Where would some weakness lead us down to? What levels can we watch for? Where's the ceiling right now? Have we established a ceiling? Is there one a little bit higher than where we're at? So we're going to take a look at that. We're going to take a look at some pretty significant moves in other assets, particularly the dollar, bonds, and what they're doing, and what the bond market continues to tell us about the Fed that the stock market apparently is not. So we're going to break that down and how unique this rate hike cycle has been. Talk about that, or at least will be, because we're just barely starting. And then our trade idea is a stock that you wouldn't expect to do very well with an inverted yield curve, and so we're going to take a look at what it did today and really what it's done the last 2 days now that we've gotten down to zero, and then how can we trade that. So let's go ahead and get started. Today is Wednesday, March the 30th, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's start off taking a look at the S&P 500 with the Market Forecast Indicator. So, again, our second down, well, I guess you count that day's third down day. That was hardly a down day, but really our second somewhat significant down day. You can look at it from this perspective too. Daily price moves here. You can see all the green bars. We had one smidgen of a red bar right there, but really the only two down days out of the past 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 days. Pretty big move here. You can see the volatility has dropped below historical volatility, and you can see the gaps just really insignificant there. So not really that big of a move today. Not still above the 62% retracement, the resistance that we broke out above. So there's the bullish pattern is still in place. Obviously, dark green shading the green line. We're still very far up above the moving average. Remember, this is one of the highest levels that we've been above the moving average in a long time. Outside of like a significant COVID bounce, right? So very, very significant move on really not that significant of a decline. When I say that, remember again, I'm referring to the McClellan oscillator that never did get below minus 100. So on this entire decline, see, it did during COVID, it did during 2018, it did at the beginning of 2018, but it never did here. So put that in perspective in terms of how significant this decline was. We did drop down to about minus 732 on the summation index. Obviously, we typically get down on these corrections to about minus 1,000. If you look at, again, if I were to draw a line here, let's just go to where our current 747 looks like. So let's just go 750, minus 750 on this to be our current low point of this drop right now. So there's COVID, there's fourth quarter 2018. First quarter didn't get there. All right, that wasn't that big of even though it was a big drop to the downside, summation just barely got below zero, so it wasn't that big of a move. 15 and 16 got down to 750, but nothing really more than that, and then you got the thrust back up to the upside there to end it. And you can see 2008, like the real significant selling, but it also started in 2007. We got down this low, and then at the end of 2007, when we started the actual correction, there we got down this low. So this is a relatively low level for the summation index, and you can see we're still not above zero. As bullish as we've been, we're still not above zero, which is outside of getting above positive 100 would be our and really it's kind of hard to get that because we never got below minus 100. So getting above zero would really be that kind of initial stage of bullishness, with the kind of the confirmation stage of bullishness being getting above 500, right? Because then now that confirms first the thrust, then the shift to the positive, and then the confirmation that we are going to actually be strongly bullish here. Also, another thing too that I had shown you before. Let me bring this back up. The new highs and new lows is updated for today. Let me just make sure. Yeah, we're at 94. So again, getting above 100 is significant because we've been above 0 before, but we never did get above 100 since things went pretty negative. So it's a positive sign to be up where we are, but we're still not quite strongly bullish. You can see the skew is still very high. So the option market is still concerned about what's the risks that are out there. So they're still very much in demand. These far out of the money puts are still very much in demand. Not as much in demand as they were in 2021 when the market was insanely bullish. But still, compared to previously to that, these are getting to 140 is pretty high levels for the skew, generally speaking. If we come back over here and go back to this, so the near term line's been above 50 for 12 days, your 11 days. That's your typical time frame. So we did get a bullish intermediate confirmation signal with a strong bullish intermediate posture. It's now above 90, and then the momentum line dropping. The momentum line didn't drop very much. So that's actually a really good bullish sign. The problem is that we haven't got the near term line declining, and it's been up here for this is a pretty mature near term run. Needless to say, right? I mean, obviously, you look at the zigzag here, and you can see if I were to change this to a 10% move, you can see that this is a pretty mature run, right? We got above 10%, 11% to the upside after a 13% drop. So, and this is all in pretty much one near-term run, which is what we're on right now. So that I wouldn't be too bullish on this intermediate confirmation signal, not like the last one that we got here, where at least you got a few more days out of it, simply because we're so mature in the near-term rally. That doesn't mean that we can't be more mature, right? We could double that. It's rare, but we could double that. But the odds are that we're probably a lot closer to the end of this near-term run than the beginning, and so, which means at some point in time the blue line is going to drop below 60. Below 50, and at some point in time below 40, right? And that's when this near-term run will actually end, is when it gets below 40. So when it does, how far down is it going to go to? And that's the big question mark, right? When you look at Fibonacci retracement on this near-term rally. Here, let me just color this one so we can kind of make it stand out as being for this near-term run that we're on right now. So that's the near-term run. This one would be kind of more for the intermediate run, the bearish intermediate run that we've been on. That still, remember, we still haven't gotten back above 78, so we still haven't got to the point where bullish moves are impulse moves. So as of right now, bullish moves are still pullback moves, and this is a really, really good pullback, but it's still a pullback until you get above 46.67, and now you have bullish moves that are impulse moves. Of course, we don't have bearish moves again, being impulse moves until you get back below this 23% line, which happens to be on this near-term run, the 78% retracement. So kind of lining up down in that level. But on this, if the near-term line were to drop below into bearish territory, which is actually what I expect will happen here the next short term, right? Next so many days. I don't know how long it will take. Typically, it only takes a few days, right? So, but how far down will we go? Probably worst case scenario down to this 44.60 level. 38% retracement of this rally. It's also the 50% retracement of this near-term run, or intermediate run. And we'll probably, going through expiration, probably stay in this area right here, where the floor will be this 50% retracement, the ceiling will be up here until we break out one way or the other, right? And so obviously breaking below the 50% would get us down below moving averages again and get us on a bearish divergence, which we'll talk about here in just a second. All right, so that's the market forecast. The weekly chart still looks very good. Good bullish candle, closing above last week's high so far on the Hakunashi close. Rising PPO, positive differential. It can't be more bullish than that. It's a great, great candle. The Russell's been the one that's been lagging, but even that's got at least a bullish candle. It's not closing above the prior week's high, so it's not nearly as bullish there. But we do have the green arrow. We're above the 10-week moving average, and the PPO is rising. So it's not positive, but at least it's rising. That's been the indicator. It's been lagging, right? And when we look at the the oscillators, you can see lots of green shading. That means that this is an intermediate run that typically lasts 1 to 3 months. I'm kind of leaning towards this one lasting a month, so we'll see how long that ends up lasting. I remember, and it started over here when we got above the moving average, so we're already actually a couple weeks into this intermediate run, and we can still just pull back to the 30-day moving average and actually still be green shade or still be bullish on the intermediate posture on the market forecast. We don't have to go up every day. And we probably won't. And if we do, it's going to be a grind because the histogram's already falling on all of these indexes. All have 3 green arrows, but the histogram's falling, which means, and I brought this up on Twitter today. If you follow me on Twitter, I posted this right here. Let me scroll down. It's actually this one here. So I posted about the MACD peaking at these high levels when you get a really small range. At the time I posted this, the range was 1.39 points. We finished with 4.73. So we still actually finished just slightly above the middle 50%, where those others were right around 50% too. So it was actually a much smaller range, but the concept is, and we might get a small range tomorrow, the concept is that it appears that the MACD may be peaking here, and which means ultimately you can see all these other instances the MACD peaked after the histogram peak, no less, but the MACD peaked, and you notice that we basically just kind of went slightly to the upside but more sideways as the MACD eventually crossed below its moving average, and then eventually later, with a few weeks later, we dropped to the 17, and it happened over here too. Same exact thing. And you can see once we dropped to 17, the MACD really dropped, right? Really, it took a turn to the downside, a much different angle. So don't expect like we're going to drop all the way down to 415 as fast as we rose, right? That's not. We're too bullish for that to happen right now. But do expect that we'll probably stay again between the 0 and 38% retracement here in this area for the next few weeks, and maybe get a little bit of a grind, but start kind of grinding so the 17-day catches up to where it's at right now. If you look at IWM, it's a little different story. Like we broke above, very significant breakout above this 23% retracement of the market sentiment rally, post-COVID market sentiment rally, and then the 38% retracement of this bearish intermediate run. We talked about this actually yesterday in my class, but very significant breakout that has a potential of being a fake out, especially considering that we had a bigger than average range today on the Russell, bigger range than what we had yesterday, and we ended up coming back down below the support and holding the value area of the last year for a resistance level. The MACD is, same thing. MACD may be peaking at its higher level of this decline after the histogram peaked, and of course you would still be above the 17-day moving average. So things don't really get nervous from a bullish standpoint until you get back below those 17-day exponential moving averages there. Let's take a look at some of these other oscillators. The DMI is still in great bullish territory there, so nothing too concerning. On IWM, not so much, right? The negative indicator did not end up dropping below 20, and the positive is still above 25, but did not drop, cross up above 30, which is where that signal is. Again, we got that, was it the cluster on the Russell 2000 yesterday. We'll see if that ends up being kind of an actual overbought cluster where we can't really get going again. SPX is still at good bullish levels, so that CCI is not very strong. It would be much better if it were stronger. The RSI, the CCI on the Russell is giving us a real significant divergence pattern. Again, not getting to bullish levels, and you kind of had a flirt with getting above 60, obviously not holding. You look at your linear or trend strength indicators, you have a good strong intermediate trend going and you're above the cloud in SPY. Not the case for IWM. You broke out and looked good, and we're still kind of above the cloud, but not very significant, and tomorrow's going to be very important there for an index that only has a weak bullish trend going right now. Very, very weak. About as weak as you can have on IWM. And then finally, from a Bollinger Band perspective, I talked to you before about how we're already really high. This is what's a very limiting factor for SPY going forward, because we're not, we're not getting above 100 because the bandwidth is already really high, and this is lagging. So it's still going to go. Even if we went sideways a couple more days, it's going to keep going up. And we're not in the upper quartile. We're barely in the upper quartile. But if you look at IWM, we're actually coming back down, right? We kind of looked like we were going to break out into the upper quartile there, came right back into the middle half of the, and you can see again holding the value area, this is the only index that's below the 1 year value area and below its point of control for the 1 year. Let's take a look at today's trading range. Here, and you can see, it's pretty relatively inside day until the very end of the day, but still lower, only a slightly lower high, only a slightly lower low. We actually closed above the low point, so not that bearish. The Russell was a different story. The Russell gave us a lower high, gave us a lower low, and that was a pretty decent range for IWM yesterday, and we actually did close below that low, despite, with it being a much bigger range than what SPY had, and we're filling in that gap. So not a runaway or breakaway gap there. So again, really bearish sign for IWM, especially if we were to come back below 200 after this kind of quasi fake out. That's, that again, fake outs are a lot more bearish than resistance just holding in the first place. If you look at the volume in the trading range today on the S&P, at least 79 million, 4.73 on the trading range. Let's put those numbers in perspective. 4.73 is way down here. 79 million is also way down here. So these numbers are still falling, but not to, below 1%, right? 4.73 is just barely more than 1%. 4.58 right now is 1%. So, that kind of gives you an idea of how bearish it would, how once we're bullish, then, you can see these numbers have to really stay low to bring this back below 1%. And that's the mark when you're below 1% where you're bullish, right? Where the trend is established and you're bullish. And we're still a little too volatile on an average basis, at least, to be considered like that we're in a strong trend. Finally, the volatility index is still very low. Like, we finished below 20. We made a brief run above 20 here, but we ended up finishing below 20, and then you notice we're still very low. Like, we're extremely low in volatility. And I showed you that the MACD, and I posted that yesterday as well on Twitter. The MACD for where is it? Is it not this one? It is. There's a new highs in there right here. So the MACD is the lowest that it's ever been. This is the lowest that it's ever been for the MACD. Like, it's 10.5%. It's extremely low. And when it gets these lows, you get these red dots, you get these lows. In this case, you're above the 200-day moving average coming off of this peak. But in all these other lows, when you're below, like we are right now, you can see it ends up moving higher. Right? We end up developing those lows. Here we were above it again, coming off that 2019 low point. But some of these others, when the MACD is down, we end up moving up, and so this is even lower than we've ever been, right? So a move to the upside in volatility is forthcoming. How long it takes, it may take some time, but I believe that we're establishing the low here towards the high end of this range. I wouldn't be surprised if we get back above 20 relatively quickly, right? Where 20 ends up being the low point, especially considering the average. And again, I expect that we'll get a near-term pullback. How big it will be, I don't think it will be that big. But I do think that we have a short-term peak here. Multiple indicators tell us that, and you can see again looking at the Hull indicator was something we've looked at before too. And let's look at SPY. But you can see the Hull indicator. We're starting to slow down. We had a really good bullish candle, not so much of a bullish candle today. And then you can see we're going to get kind of a neutral candle here tomorrow at best. So, we're not going to flip the script anytime soon. You have to get a red line. The 200's not moving up yet either. So we're not quite there, but I think we're going to drop below here the 20-day Hull moving average. We'll get some at least transition candles, something like this, and then it'll be a matter of whether we end up turning bearish or not. See, we can stay kind of sideways for a while while the green dots, while the parabolic SARs eventually climb up and catch up to where we are. It'll take about a week or so. So again, probably just a normal 30, 23, 38% retracement and some ups and downs, and that's probably it until we go sideways enough like this for these to catch up, and then we can flip it, and we'll see how long that takes to see whether or not we end up turning green. I don't think I think we'll actually will. I'm expecting another leg lower here. I don't think that we're starting a bullish trend. I hardly think we're starting a bullish trend. This has been a very, very weak breadth in this move based on what I've shown you. So I think this has been a very sharp response to decent headlines out of Ukraine. But as we see with the bond market, you'll see in a minute, the bond market could care less what's going on in Europe. The stock market is very, very driven by these headlines, and so I think that's all we got. And now the focus will return as to what the bond market's always been focused on, and that's this high inflation level and the Fed's policy path going forward from here. So what do you think? Do you agree with that? Do you disagree? Let me know in the comment section below, especially if you disagree. Let me know what charts or indicators you're looking at that suggest why you're either a lot more bullish than I am, or why you're maybe a lot more bearish than I am. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. You liked our video today, number one. Number two, you want us to do another video again tomorrow. Quick way to let us know that, if you like our stuff, with one click. If you don't like our stuff, of course, you don't have to click on anything. Also, while you're down there, comment. What stood out to you today? What questions or comments do you have about anything I brought up in the video? Post those in the comment section below. Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right. Click on the this icon right here that takes you to our Market Outlook live page. On Monday, Wednesday, and Fridays at 3:30 Eastern Time on this page, I do a quick 10-15 minute live video. I take a look at all the trades I've done, at least the ones that we're still in, from prior Market Outlook videos to see whether we should stay in them or not, or get out of them. And then we also put on today's trade idea that you'll hear at the end of the video today. We already put it on today before the market closed right here on this page. You can also get to it by clicking on live trade review here in our main menu. If you see our upcoming classes over here on the right, click on view more. You can see our calendar with all of our upcoming classes. Obviously we'll have April's classes here coming up soon, and then all the recordings going back 4 years worth of recordings there. Again, you can get to that over there on the right. You can also click on trading rooms up there to get to that same calendar. Come down to the bottom, click on that heart. Again, we're not quite to the 100 level there, but if you hit that like button, we can get there. Also, if you hit this thumbs up icon, same thing. It will, we'll get more likes on the Facebook post too. Again, the more you do that, it really helps us get our content out to more of our followers because of the engagements, right? Clicks, likes, comments, all the shares, all that gets added into their algorithm so that they will share it. So Facebook and Twitter will share it more to the people that actually follow us. It benefits you that because Twitter and Facebook promote content in your timelines from the accounts that you engage with the most. We try to make it really easy for you to engage with us right here, right now while you're watching. All right, now let's take a look at what's driving the price action today. And you can see today was a risk-off day, right? IWM was down 2%, Qs were down over 1%, finished off the lows, but still down over 1%. You can see gold and bonds were up today, along with commodities. But outside of that commodity move, which is basically an oversold technical bounce because they had a pretty sharp drop previously, but seeing gold and bonds going up and the dollar dropping, that's another significant pattern that we're seeing here. The euro US dollar following up yesterday's pretty good move with another strong push above the 30-day moving average, and the 8-day MACD going positive, 8-day crossing above the 17, and both lines close to crossing above the 30. We've been converging for so long that they're very close to crossing about 30, the 30, which is actually a very good bullish sign. A good chance that we can start to fill in this gap. We've already filled in the gap between the 30 and 50, and then this is the long-term trend line for this over the last 15-20 years, back above the 78% retracement of this little run that it's been on. Right, this little rally, so we're back above the 78% retracement level. So there's an opportunity now to make our way back up towards 62% retracement or higher. There's a long-term 62% retracement. There's going to be some significant resistance at 114, but I think there's a good chance we make a run up to 114. And of course, that has been bullish. That has coincided. The weakness in the euro has coincided with weakness in long-term bonds. So that kind of move would coincide with a move to the upside in long-term bonds, and long-term bonds have been relatively negative, have had a positive correlation with equities for most of this last year until this last break where bonds dropped and stocks rallied. And I have a feeling that that's going to shift, right? That divergence is going to correct itself, which again is why I also believe there's going to be another bearish leg lower, and if we actually do get a bearish leg lower, I would expect it would be bullish for long-term bonds, unlike this last leg lower where it's been really bearish because of the jump in yields. But the jump in yields is going to be, the rise in yields from now on is going to be really, really limited by the spread, which is down to 4 basis points now, and that's a really small number, and you expect that, see, we broke the 20 basis point handle. Now that 0 is the new handle to break if we break below that. And so again, that's going to put pressure on rising yields. The 2 years already well up above. I see I made this chart here. This one. This is how far away the 2 year is from the 3 month. The 3 month is a lot more sensitive to where what the Fed is actually doing. The 2 year is what the bond market says the Fed should be doing, and this is what where the Fed actually is at, right? So a lot closer to that at least. So you can see it's not very common. In fact, I tweeted this out too. Kind of easier to to highlight the tweets because I've already made the argument. But if you go out here, it's not very common to have this big of a gap between the 3 month and the 2 year. In fact, you notice it usually happens when the Fed has cut interest rates, so that they've cut it to a real significant low point. That's why the 3 month is so low, because the Fed has cut rates. They usually, before these recessions, they raise rates, right? And you notice the other thing that lines up with these recessions is an inverted yield curve. At least right here, an inverted yield curve, right? You get inverted yield curves before those recessions. Well, the last time, again, that we had this big of a gap between the 3 month and the 2 year, again, was after a year-long rate cut cycle, not the beginning of a rate hike cycle like we have now, but a rate cut cycle. And at the time, the yield spread was 200 basis points. But now we're at the beginning of a rate hike cycle. The yield spread is inverted, and the real Fed funds rate, which was neutral, negative, 0, at that time, that the 3 month was, again, at the end of that rate cut cycle, the Fed funds rate was 0. On a real basis, it's insanely negative now. So this rate hike cycle is not like any of the other ones that you're getting a lot of comparisons to, right? This is has a lot more potential to really roil investor sentiment, because it's not the same rate hike cycle you saw in 04 to 06. It's not even close to being the same rate hike cycle we saw in 15 to 18, right? Here, this rate hike cycle here. So not even close to that rate hike cycle, not even close to the 04 to 06 rate hike cycle. If anything, it's going to be pretty close to the 94 rate hike cycle, even though this actually happened at the end of the rate hike cycle, not at the beginning. But if anything, this is going to be very similar to 1994. But again, a lot of people have been using those rate hike cycles as a comparison to what we see now. Much different, right? Because the the yield spread is actually inverted now, not at the end of these rate hike cycles like normal. It's actually already inverted now, and the Fed funds rate is, isn't positive like when you at the end of these rate hike cycles. Again, when you had these yield curve inversions, the real Fed funds rate was positive, was over 250 basis points positive. It's 750 basis points negative now. So it's a much different cycle than you've ever seen. In fact, the only time we've ever seen something similar is the late 1970s, and we kind of know how that went. It was a period of a lot of volatility in the markets and high inflation and stagflation. Not a lot of economic growth, and so you can kind of get an idea there of what we can expect to see. So it's, again, I'm actually kind of bullish on bonds. I think we're going to get back above the 62% retracement and get above these moving averages. We're not there yet. It's a great day today, but obviously the MACD is above its moving average, but we're not above the 17-day moving average yet. That's kind of the stage to where, you get bullish on long-term bonds. Gold, you can see, had dropped to the 50 yesterday, but then hit it and then bounced. And now we're almost back up above all these moving averages again, with the MACD potentially turning back up. Stochastics already has. So again, that's a safe haven. It's interesting to see how that, and I think there's been some chatter about how bullish utilities are. I mean, look how bullish utilities are. Look how bullish real estate is. This is not safety, right? This is not a risk appetite. This is safe havens. And so that's a little bit of a concern. If you can see here, if I were to look at today, the sector move, the comparison for just for today, you can see energy, of course, because that's been so oversold, and that's kind of acting as a safe haven. But so is utilities, their staples, healthcare. I mean, all of these are your safe haven areas outperforming your more cyclical areas, especially XLK, XLY, which have been the two biggest winners, right? They were the two biggest winners since this whole thing started, this whole rally started. They were your two biggest winners. They dropped the most. Energy was the weakest performer. It rallied the most. And, of course, there's all your safe havens that are going to outperform too. But those two, they've bounced the most. And, again, why have they bounced the most? Because if you look at, from when this whole period of weakness started, going into that low point there, they were the ones that were down the most, right? XLK, XLC, XLY, all really coming down from those levels. And really, even more so when you go because that was when the Russell really started its decline. The S&P started its decline here. I mean, 20% drops. So, of course, they're going to be up the most. And they were the last 2 weeks. And, of course, because of that, they were down the most today in the risk-off move. Okay, that brings us to our trade idea of the day. I'm going to take a look at another stock. I've got a trade already in one stock in this sector. We're just taking a look at another one. And that's Wells Fargo. Wells Fargo, really bearish day today after a pretty bearish day yesterday. Good to open yesterday. Light green shading, yellow line, but then now back to dark pink shading and a red line as the intermediate line drops back potentially into bearish territory. And then your near-term line giving us, multiple bearish peaks in a row, near-term bearish peaks. Even though there's kind of slightly higher, it was slightly higher, not really, kind of equal. But now rolling back down, they're getting down more than to 2.5% below the 30-day moving average. And like I said, closing below a lot of lows here. Really bearish reversal on Wells Fargo. If you take a look at where it's at on the moving averages, you can see back below the 17-day moving average. MACD is back to being negative. So the 8-day slightly below the 17, but it's not below its moving average yet. Stochastics is. So it looks like it's setting up for a run, a pretty much a failure of the resistance and a run back down towards the 200-day. Now, last time it got to the 200-day, it was a big drop and it was a fast rebound. I don't expect it to be so quick this time. I expect it to be more gradual, especially with strong support here as it puts more pressure on that support. Remember, the financial sector has been one sector, especially this one within the financial sector. This stock, hasn't been as bearish, right? You can see, though, if we hit that low again and break it, then Wells Fargo will do what some of the other stocks are doing. This is J.P. Morgan's the stock that we've been looking at and another stock here that we've been trading, and again, it would make a run towards a 200-week moving average and below the 50 that Wells Fargo just hasn't yet. Wells Fargo, of course, was a lot more bearish previously during COVID, so it had this is barely above the 200-week and potentially is hitting resistance now on the upside from a long-term standpoint. Let's take a look at some of the other oscillators. So these oscillators didn't really give us good bullish lows and are making their way back into lower halves of the charts. There, you look at the directional movement index and you think, okay, we're going to really get going here. The positive gets above 25, barely, right back down. The negative gets below 25, gets right back up. We get a bearish crossover there. You're looking at the Ichimoku cloud, and you can see we're right back below both the green and the blue lines, still below the cloud. So you can see the bearishness on that. From a Bollinger Band standpoint, we were trying to get up above the upper half of the chart, and now we're back into the lower half and flirting with getting into the lower quartile there. So and back into the point of control where you'll be drawn now, or in the value area, excuse me, where you'll be drawn to the point of control, which again is to that downside and very significant support, because you remember on the long-term chart, you break this level and there's no volume below it. So it's really easy to do what JP Morgan has done in the prior market outlook trade that we've done, that we're still in actually on JP Morgan. So if we take a look here at this chart, the long-term chart here, the weekly chart, the last one I wanted to take a look at, with this move, again, we were bearish, we were trying to be bullish, got a green arrow, but the PPO is still falling, got positive differential, but the PPO is still falling. Well, now we got the three, the bearish signal. So the red arrow, which the week's not over with, but the red arrow, falling PPO, and a negative differential down here. So that's, of course, that is our potential for bearishness that can really put some pressure. Like I said, like we never did. JP Morgan's been a lot more bearish, and you expect that to catch up to some of the other sectors within other stocks within that industry. So what we decided to do is come over and be a little bit more aggressive with our May, since we got 50 days out, is selling the 42.5 put and buying the 45. So a little bit out of the money, right? We're going actually down to the 20 delta to buy. Typically we buy at the money, so we went a little bit further out of the money. It's a little bit more speculative move, but it allows me to keep my risk really small. So if it does bounce up, we get a really, really small loss and a really decent size reward if it ends up playing out again as we expect that it would. So that's the idea behind that trade, and there's our trade idea for tonight. All right, and that wraps us up for today. So you've heard from me. Now I want to hear from you. Use that link popping out in the top right corner of your screen that takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video, subscribe to our website at marketscholars.com. Like us on Twitter and Facebook as well. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.